Source code speaking. OG, John AG here. Verify the handle. OG John AG. Same on YouTube, same on X. Someone in the comments asked me why I have been talking about oil for the last few days. Today you have your answer. Brent just broke $90. WTI at 87. Qatar warning 150 within weeks. This is why we talk about more than just precious metals here. You need to see the complete picture. Every asset class, every variable, every connection. That is the only way you become truly independent. Not relying on anyone to tell you what is happening, including me. You see it yourself. You connect it yourself. That is the goal. I am going to be deploying data and tools on X very soon that will help you get there. Follow me at OG John AG on X. Nothing there for me. No courses, no signals, all free. If you are serious about understanding how these markets actually work, it will help you. If you are learning something here, drop OG in the comments. One word. That is it. Today a lot landed at once. A jobs report that just confirmed stagflation is here. Oil breaking $90 for the first time in 2 years, with Qatar warning 150 within weeks. Silver vaults in Shanghai 15 days from empty. Comex paper market hollowing out in real time. Silver bounced from 81 to 84 and is holding. Gold recovering while everything else sells off. Let me take you through all of it. The U.S. economy lost 92,000 jobs in February. The expectation was a gain of 58,000. That is not a miss. That is a completely different direction. Unemployment climbed to 4.4%, above the 4.3 estimate. And here's the part that matters more than the headline. Average hourly earnings still rose 0.4%. Jobs are disappearing and wages are sticky. Those two things happening at the same time have a name. It is not a soft landing. It is stagflation. The Fed cannot cut without feeding inflation. It cannot hold without accelerating job losses. That is a trap with no clean exit. And the market started pricing exactly that today. The S&P dropped over 1%, the Nasdaq 1.5%, the small cap Russell over 2%. Yields fell at the same time. When stocks and yields both sell off on weak jobs data, the bond market is not signaling rate cuts ahead. It is warning about economic deterioration. That regime shift in how markets read data is the thing to watch. On top of that, retail sales already fell 0.2% in January and consumer spending flatlined. Americans have stopped spending while prices are still rising. The soft landing the Fed spent 2 years promising is not delayed. It is dead. Now add the war on top of that. Brent crude broke $90 for the first time in 2 years. WTI is sitting at 87. Trump posted unconditional surrender as the only acceptable outcome with Iran. No negotiations, no ceasefire, full capitulation. Qatar's energy minister warned oil could hit $150 within 2 to 3 weeks if tankers cannot move through the Strait of Hormuz. Natural gas prices could rise 400%. Qatar says global GDP takes a hit if the conflict continues even a few more weeks. Kuwait has begun cutting production and is now discussing limiting output to domestic consumption only. Roughly 2.6 million barrels per day of production is at risk. Oil storage across the Gulf is at capacity. Russia is supplying Iran with real-time intelligence on U.S. ship and aircraft locations. Iran says its upcoming attacks will be more intense and widespread. This stopped being a geopolitical backdrop some time ago. It is now the primary variable in every asset class simultaneously. And here's what this does to the inflation math the Fed is already losing. Every $10 move higher in oil adds roughly 20 basis points of inflation pressure. Oil has moved from the mid-50s to 87. That is more than a full percentage point of additional inflation already in the pipeline. At $100 oil, you are looking at CPI pushing past 3% while jobs are being lost. The Fed is not in a corner. It is in a sealed room with no doors. Now silver. Because the physical market today is saying something the paper price is still pretending not to hear. Western spot is at 84. Shanghai spot is at 96, $12 premium. But the premium alone is not the story. The vaults are. Since October, the Shanghai Futures Exchange lost 77% of its silver inventory, dropping from 36 million ounces to 8.2 million. At yesterday's drain rate alone, another 539,000 ounces left in a single session. At that pace, those vaults are empty in 15 days. The Shanghai Gold Exchange tells the same story, down 64% from 39 million ounces to 14.3 million. Comex registered silver is at 91 days at current drain rates, down 34% over the same period. 3 separate exchanges, 3 separate continents, all draining simultaneously. Someone knows something. And here is the detail most people are still not connecting. Silver backing Comex futures contracts has been falling by approximately 20 million ounces every single month for 6 consecutive months. Every day the market waits for inflows that are not coming. The math on that is simple. Either the inflows arrive, or price moves sharply higher to ration what is left. There is no third option. Meanwhile, comex silver open interest just hit a 12-year low and trading volume has collapsed. The CME's response? Cut silver futures margins 22% in a single move, making it cheaper to hold positions in a market where the physical backing is eroding fastest. Traders are also watching SHFE gold open interest collapse to a 3-year low. Leverage positions are being unwound across the board. The paper market is hollowing out while the physical market drains. Those two things happening together. That is not noise. Now here is the piece getting almost zero coverage in Western financial media, and it is arguably the most significant structural development of the week. India's securities regulator issued a circular effective April 1st requiring every mutual fund and ETF holding physical gold or silver to stop using the LBMA London fixing price as its valuation benchmark. From April, they must use the domestic spot price polled on Indian exchanges. The official reason is uniformity. The real reason is that India has already watched its domestic silver prices detach massively from London prices twice in the last 6 months. In October 2025 and again early this year, because physical metals simply could not be delivered fast enough from London to meet Indian demand. The arbitrage failed, price decoupled, and India's regulator quietly rewrote the rules to reflect what is actually happening in the physical market rather than what the paper benchmark says. When one of the world's largest silver consumers formally moves away from LBMA pricing, you are watching the architecture of the old system being replaced in real time. The ones paying attention see what that means for pricing power over the next several years. Now the price picture and the honest part. Silver bounced from 81.60 at 8 this morning and has recovered to 84, up 3 to 4% in the New York session. The short-term tape is cleaner than it was 24 hours ago. For that to hold, those morning lows at 81.60 cannot be revisited. If this market wants to move higher, it should not need to retest that level. The next areas of interest on the tape are 85.50 and 86.80. This is tape reading, not a signal. It is observing what the structure is showing, nothing more. Gold is at 5,149. It spiked hard on the 8:30 NFP print, gave it all back within 15 minutes, then pushed higher again as the dollar softened. That is the pattern we have been watching all week. The algo pressure at 8 in the morning is still in play. For the tape to stay constructive from here, we do not want price revisiting the 8 a.m. lows. If it holds above those and continues, the levels to watch are 5,180 and 5,200. But this still depends heavily on the dollar. The DXY is starting to look weak on the chart, but it is not clear yet. Same plan we discussed. Nothing has changed there. This is tape reading, not a signal. Just observing what the structure is showing. The bear case is real. Thin participation means price moves in either direction on limited volume. The margin cut makes it just as cheap to hold paper shorts as it does longs. War headlines change by the hour and carry tail risk in both directions. The dollar resolution is unclear. None of that changes the structural picture. Here is what today confirmed. The jobs data broke the soft landing narrative on the same day oil broke 2-year highs on war escalation. The Fed is simultaneously facing rising inflation and rising unemployment. Retail consumption is contracting. The physical silver market across 3 continents is at multi-year inventory lows with no meaningful inflows. India is quietly removing LBMA from its pricing infrastructure. And the paper market is hollowing out just as the physical squeeze tightens. The question worth watching is what happens to COMEX registered silver over the next 30 days as SHFE approaches empty. When the Shanghai Futures Exchange is down to the equivalent of 4 days of global mine supply in its vaults, that is not a silver market operating normally. That is a market where the paper physical gap is becoming a structural problem, not a cyclical one. Watch the positioning data that follows this margin cut. Watch which direction open interest moves. That is where the next chapter starts to write itself. Check the COMEX inventory reports. Verify the CME margin data. Invest with logic, not hype. OG out and about.